Good day, fellow investors. Today we'll discuss investing strategy, and I want to explain why my investing strategy now is to be fully invested. No matter the high valuation, the possible crashes, the economic situation, the money printing, I am still fully invested. We'll compare the market situation, the monetary situation, and then I'll go to three strategies, my strategy, fully invested, cash waiting for a crash, and having a percentage of your portfolio in cash, and you will find the best strategy that suits your investment requirements. That's the key. If you get value from this, all I ask is to click that like button because it's the best way to support the channel. Let's start. So the topic of this week with my videos was investing strategy. First, I gave my crash strategy, how despite being fully invested, I'm always looking forward for a crash because it increases my long-term returns, no matter how you approach it. Then we have discussed how there is a lot of money printing going on, inflation, higher inflation expected, allowed by the Fed, and they will keep putting liquidity into the system. And then next step, Ray Dalio came and he said that with what the Fed is doing and will be doing for the foreseeable future, there is a huge risk for currencies and a terrible risk-reward situation for bonds. And when you compare all of these things, then it is wise to be invested in stocks. However, yes, the market is at all-time highs. If we look at the S&P 500, it is almost at 4,000 points, which is really high, especially compared to I think it was 666, the low in March of 2009. That's crazy. So the market is up more than 5x over the last, 12 years. That might be an indication of a bubble, but I am still fully invested, and I'll explain why. And that might feel irrational because if you look at valuations, this is the Shiller price-earnings ratio that takes into account 10 years of earnings to value something. And if we look at the S&P 500, we take average 10-year earnings that smoothens out effects like COVID or other recessions, we can see that it is at 35.20, which implies a long-term return of around 3%. Compared to history, the only time it was higher was in the dot-com bubble of 1999-2000, and it was even lower in 1929. And if you look at valuations, historically, also high valuation in 1960s, late 1960s, you see that after the high valuations, what followed was terrible returns. From 1999, it took, 15 years for real returns to break even. 15 years. This is inflation adjusted. From 1969, it took 30 years. 1966 was the peak of the Dow, and it took 30 years to have zero returns. 1929, the peak of the Dow, inflation adjusted again, it took, 25, 27 years, a little bit more, 30 years to return to absolute zero. So you might think, Sven, you're crazy, you are totally invested, but the numbers show that your long-term returns for 30 years will hopefully be zero and negative real returns over the next 10-15 years when everything crashes. And yes, the valuations are sky high, but those valuations were similarly sky high 5 years ago, 7 years ago. So by thinking that the crash will come, I would have lost the 4x I made from 2010 till 2015, the 2x from 2015 till 2018, and almost now, since I started my portfolios on my research platform, another 2x. So if you multiply that, that's 20x. That's crazy on a portfolio. And even if now we have a terrible crash, I'll still be 5x, 10x up over the last 10 years. And I can reinvest build what I have been doing the last 20 years, build on that, and simply own assets over the long term. Let me explain this. So if we take a look at valuations, those have been sky high already. Let's say this is 2015. 2015, the CAPE was close to 30, 27, and also historically extremely high. Only during the peaks of exuberance it was higher. However, if you look at the stock market 5 years ago, despite the high valuation, look at this, it almost doubled over the last 5 years. And it seems incredible that just 5 years ago the S&P 500 was around 2,000 points. But the risks were the same. Valuations were high, the economy risks were there, China issues were there, China was slowing down, so better sell, 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 sell. Those that sold, of course, the result is staggering. So there is always risk, but you have to see what strategy, no matter the valuation, and you have to see whether you can find different valuations for lower risk and higher returns. So from that perspective, you never know when the market will crash, and we'll discuss more market timing in the free strategies. Then we have something else. Ray Dalio just said how cash is trash and bonds are even trashier, and we are seeing the Fed, the ECB, everybody printing so much money like there is no tomorrow, which is a good strategy because tomorrow won't be here if they don't do it. So they do what they can do, but there is one certainty. Currencies are losing value, and I have been feeling that already for the past 6-7 years. I have been fully invested. Real estate, we bought one, sold one, bought again, and the period that I had a lot of cash to buy the other real estate, I was feeling a little bit uneasy with that cash, because what if now a cash crisis hits, then I lose a lot of money by sitting in cash. So I feel more comfortable by not having any cash. And the thing is that I have lived through money losing its value twice. So grew up in the former Republic of Yugoslavia, so this is all worthless money. Then it became Croatia, again more money that is worthless. And perhaps the best example is this. So this is already the second inflation. So this girl, she was very happy, she could buy a lot of things with 10. 3 years later, I have a bill here, same girl, she could buy much less thing with 50 million. So 10 became 50 million, and this was worth much less than this 10. This is inflation, this is what can happen, this is a risk that might not happen this crazy, this is really crazy hyperinflation, but it is something certain, and I have to do a video why they are targeting always inflation. If we look at the purchasing power of the dollar over the last 100-something years, you can really see how it went down, down, and down. This is because everything is easier with inflation, the government gets more money, easier to pay off debt, etc., etc. And you never know when and how fast will the purchasing power deteriorate. First World War, it was very fast, big inflation, so 50% loss in a few years. Then similarly, after the Great Depression, again Second World War, huge purchasing power deterioration. Then again, fast over the 1970s, and now we have been living in a great period of low inflation and low interest rates. So really a great period. But you never know whether it might deteriorate like it was the case in the 70s extremely fast again. So these are the cycles, and I wouldn't dare to project my investments on macro things like this, how big inflation will be. So I prefer to simply avoid these risks that are there and are normal in human history, especially now that there is so much debt. So yes, I expect this to happen sometimes, somewhere. So again, a fast decline in purchasing power, which means it's better to own assets. Plus, the second reason for my fully investing strategy is I can still find good businesses that are fairly priced. And that is perhaps the key. If I would only find high-risk investments, I perhaps would be waiting or searching or doing different things. But as long as you can find good investments I'm not greedy, I don't expect to the moon, I expect just good and slow and steady compounding. So, for example, 6 months ago I did an analysis on Intel, the stock price was around 50, and I said I'm buying for earnings, dividends and buybacks. This is my strategy, this is why I bought, no matter what could have happened or has happened. The risk reward was positive for me. And of course, this was in September, and in October, November, I was already being called an idiot, which is good and which makes me feel great, because then I know I'm doing good. And I'll make a video on Tesla next week, because I haven't been called the Tesla idiot for a while, so we have to remedy for that. And then Intel just kept doing what it has been doing business, selling chips, making cash flows, and now the situation is already a little bit different. But if I put this into my valuation table, you can check this also on my research platform if you wish. I have used 15 billion in free cash flows for Intel, growth of 4% as demand for chips is growing, a terminal multiple of just 15 on the cash flows, and the intrinsic value is 235 billion in market capitalization. If I compare the market capitalization, 260 billion, this means that Intel will likely still deliver 8–9% returns over time. There is a dividend, there is buybacks, the price-earnings ratio is still low. In an exuberant environment, let's say that Intel becomes fairly priced as the market, then there is still the potential double, and the downside is still 60% in the worst case scenario if Intel doesn't simply work, which is also possible, and I always keep this in mind. But my sum of valuations is still, for a 10% return, Intel is still, let's say, fairly valued. That's a good thing, and I like owning businesses at fair prices that do good. And are businesses doing good? Well, I see this shortages in chip markets, higher and higher demand for chips, all the other competitors have exploded, so I think that's a tailwind, and Intel will still do good in the next 5, 6, 7 years. And yes, the noise allowed it to go down with the stock price, but they were still making cash, and that's what I focus on. And as long as I can find good businesses that have good yields, 10–15% long-term expected returns, I'll be fully invested, because what's the alternative? And there is something else that's very important here, and that's personal income, reinvestment of dividends, and what's your strategy there? I have income, and that's something very personal, and it's personal for you too, but you have to think, okay, what if a crash happens? What if everything goes down the drain? Will I have income in the next 5–10 years to rebuild the portfolio at lower valuations, which means higher yields, which means I will actually retire earlier or reach my goals earlier? That's also something you have to think. And you have to think these investing things as a long-term process. 10 years ago I thought, yes, it's risky, but it is a long-term process. I get the dividends. It's better than zero in a bank. I reinvest, I build wealth over time, and that's the key focus. Plus, what's the alternative? The alternative is timing the market, which is something that a lot of people do, but the success on that is questionable. Yes, you might be right once or twice, but if you invest and if you try to time the market and if you miss the 10 best days, you destroy 50% of your long-term returns. This is for the FTSE over 40 years, so 50% lower returns if you just miss the 10 best days. If you look at US stocks, if you miss one day, then you already lose 10% of your returns. If you miss the 5 best days, 30% of returns, 15 best days, more than half, etc., etc. So timing the market is very risky, because yes, you do better if you miss the worst days, but you never know when will it happen. And those that time the market, usually the best trading days are close to the worst trading days, so it's very difficult to miss the worst, and just take advantage of the best, because everything is there close when things are volatile. So if you want to maximize your long-term investment returns, that's at least my idea, by accumulating assets over time, then you have to be fully invested at all times if you can find good investments, and then you also avoid this. That's my strategy. But you have to see how it fits you. Warren Buffett isn't fully invested, but okay, he needs that liquidity for insurance reasons. But if he would have been fully invested all the time, he would probably have higher returns over time, because here he had in 2000, he invested in Apple here, started big, so you see the decline in cash in 2016. But if he would have gone to 20 billion here already to lower his investments, his 50 billion invested in Apple would now be 200-300 billion, which would add 50% to Berkshire's return, which is a big thing. Of course, the market will crash. Better to wait in cash, better to do nothing. And this is a rational idea. Yoon Pak says that I have 100,000 and I have no idea what to do with it. Stocks are to be corrected, there will be a crash. It hasn't happened yet, cash is trash, I'm not buying BTC at 60,000, real estate is overpriced, and there is simply nothing to do. If that is your mentality, then you will not find investments, and we'll talk about this greed in a second. What do you want? You need to invest something that doubles in the next 6 months, or you need slow and steady compounding returns. That's also a question. Plus, if you look at crashes, and what happens is that those that wait for a crash, when a crash happens, don't invest, because whenever you look at what's going on, it's always risky. Ray Dalio was short the market here, and he was waiting for a crash, and he thought that the world will end, and he didn't buy. And many of those waiting for a crash here didn't buy here, because it will get even worse and you will have even better opportunities. By May, it was all over. The opportunity window was over. So if you focus on stock prices, you will never buy in crashes, because yes, the market crashed here, but if you wait for a crash, then you wait for the big one, you wait for lower and lower, and that eventually doesn't happen, and then you miss the best days, and you know what are your returns. So that's the problem with those waiting for a crash. Then you have a strategy of having some cash on the side, which is perhaps better if you focus on the fundamentals. It's very simple. You can say, okay, what is my expected return? Then I am 70% invested. If what I see gives me 7%, if what I see gives me 10%, I'm fully invested, I'm very happy with that, I'm not greedy. If it makes you feel better, as I said, it's personal, you can do that. However, you must not panic when the world is about to end and you have to invest, which is something, again, that people that are afraid simply don't do. So that's the worst thing with these kinds of strategy. Theoretically work perfectly, sound perfectly nice, but when actually you have to implement that, people don't do it, because the world is about to end every 2-3 years, and people that are scared are even more scared when that happens. So to conclude, we have greed, we have fear, and we have the strategy of owning producing assets that leads to wealth compounding over time. With greed, I am happy with slow and steady. I don't need stocks that go to the moon or to Mars or risking being there. Slow and steady accumulating wealth over time is my answer to greed. If you can't find anything, it is perhaps because you're greedy and you do not accept 5-7% slow and steady. If that is not good enough, then of course you cannot find anything. Fear of a crash, yes, there will be a crash, and if things crash by being fully invested, my answer is yes, I will get what I like cheaper, plus will have long-term higher returns. Which all leads to investing fundamentals for me, accumulation of value and assets, owning businesses, no matter what happens in the market. Because the market will go up and down and up and down, and the only thing I can do is accumulate wealth no matter where we are in the market. I will accumulate what I like, I will accumulate what I like here, and if I can do that over time, I'll get richer, wealthier and wealthier over time. That's my strategy. Thank you for watching, click that like button, and I'll see you in the next video.